We get a question a lot in regards to what do I do if I'm living out of state, right? How do you file for this? There's a withholding tax, right? What is that called? There's a number to it that you attorneys use?
Yeah, 71.3 as we abbreviate it. Yeah, but it's
71.3.
That's right. That's right. These are the forms that you need to file when you're a non-resident of the state of Rhode Island. And that non-resident term applies to a corporate or a trust entity as well as an individual. When this comes up, there's some factors that we ask the seller, and you really want to have representation in these situations.
Sure do.
Because you ask the seller, lay it all out for me. What did you buy the property for? What did you put into the property in terms of costs and repairs and other things like this, and improvements. And then we compile this information on the form that I have here in front of me, and then we submit it to the Division of Taxation. The goal is to do this prior to closing, because if there is a gain, regardless of the fact that you've now put in all this work, you've sold it at a good price, and you've got a gain, then there is a calculation that's done on the gain. And it's different for an individual or a trust versus a corporation.
On the gain, Ted?
On the gain.
Oh, not the wholesale?
No, not on the wholesale. So we less out. So we take the sales price, and then we less out the expenses associated with the transaction, like commissions, maybe the attorney's fee.
Sure.
I would include the real estate taxes if they've got anything being paid at closing. Then you take the basis. What are they into this property for? How much did they buy it for? And then that definitely narrows the gap. So now you've got a gap that is either a gain or a loss. And lots of times, at least in recent years, there have been losses. So we don't have to worry about it.
Sure.
But it's when there's a gain that becomes an issue.
This withholding tax, does the state of Rhode Island keep that money, or do they release it to you when they find out that you've paid all of your taxes?
Well, that's a great question. What we do is we have to retain that, pay it to the Division of Taxation, assuming there's a gain, and then the borrower, or the seller, I should say, can go and file, with their CPA post closing, some additional documentation to try to, get some of that back.
So let's look at some figures real quick. Let's just say a home sells for $200,000, and they purchase the home at $200,000.
Right.
There is nothing withheld, correct? There's no profit, so nothing withheld.
No, because what will happen is it'll actually yield a loss, because there'll be commissions,
everything else.
I would put in there any
tax
improvements.
Stamps.
Yep, tax, doc stamps, fees for the attorney. So it would definitely yield a loss, and that does happen more often than you think. You think you're going to be close, but you're not there if you plug in the number.